Hello, and welcome to Trestlebridge Capital's monthly market and economic recap. Before we begin, here's a quick note from our legal team. Today's discussion is hosted by Eric Jefferson, managing partner of Trestlebridge Capital, as he breaks down this month's key market updates. Let's get started.
Welcome to the Trestlebridge Capital Market and Economic Recap for July. With all of the geopolitical developments, actually wound up being a fairly muted month with respect to risk assets. We saw the S&P 500 grind marginally higher, plus 2%. That was once again driven by more growth-oriented companies. Bonds remained virtually flat, while gold traded marginally lower. One of the major themes for the month was that lower quality companies, those not as financially sound as others, meaningfully outperformed. I think a lot of that was a function of a topic of short covering, where companies that investors are betting against or are shorting, ultimately those managers are exiting those positions by buying that stock. That in turn can meaningfully increase the price. Historically speaking, that is a fairly bullish indicator for stocks over the intermediate term. On the geopolitical front, we saw the passage of the One Big Beautiful Bill. That's actually a topic we'll discuss in more detail in this month's Asking for a Friend. Ultimately, that was a 900-something page bill that included hundreds of different provisions. A few of the key highlights: made permanent the 2017 tax cuts for U.S. households, some incentives for small businesses, as well for corporations involved in infrastructure and research and development. I think that is another further tailwind for the AI and tech space. As a result, there were a handful of trades in the tactical portfolios, specifically one that repositioned a more conservative approach to the growth sector, one that offered some inherent downside protection, into more of a pure play, focusing on high quality growth companies. As well, we did replace one of our core equity holdings that hadn't been performing as we had expected, with one to think that offers significantly more upside potential over the long term. I want to conclude by touching on a theme that has started to gain a lot of traction in the mainstream media, and that is with respect to the Federal Reserve Chairman Jerome Powell and his decision thus far to hold off cutting interest rates. He is the outgoing Fed president. His term is set to expire next May. Granted, there have been rumors of him potentially being replaced sooner. It looks like that will not be the case. When we think about what he is ultimately tasked with at the end of the day, it is his organization that sets the baseline interest rate policy. As a quick refresher, higher interest rates generally make financing new projects more expensive. In turn, that can slow the economy with the end goal to help curb inflation. Conversely, cutting interest rates tends to make financing more affordable, therefore incentivize companies to bring on, hire new workers, build new projects. Obviously, some natural benefits to the economy there, with the risk, though, of inflation becoming ingrained and more permanent in our economy. At this point, when we think about their dual mandate, balancing full employment with stable prices, despite some of the very significant progress on inflation over the past 24 months, that has somewhat stalled at this point. Seen even some marginal ticks higher, may or may not be the function of tariffs. That unfortunately will take more time to understand. Conversely, went into this presidency with a very strong labor market. Granted, have seen some marginal softening. I know this has become further polarized by calls for many in Washington to lower rates. At this point, I'm not sure lowering rates would have a direct impact on financing. That is something the market will ultimately set rates further out. Federal Reserve's focus really on the short term, the overnight policies. Do certainly support, though, the argument that lowering rates will benefit that lower end consumer. That is the one that is coming under the most pressure today with respect to higher prices. So all in all, that will be very interesting to watch. I think at this point, Powell certainly has cover one way or the other. It will be interesting to see how that plays out over the balance of this year. Again, coming into 2025, market was expecting several rate cuts. At this point, market's pricing in now less than two. That is down substantially from where we were at the beginning of the year. That is one of the catalysts we think helps supporting some of these elevated valuation for stock prices. And so, again, will be very interesting to see how rates adjust as we continue to get more economic data in the months and quarters ahead. That's all for this month. As always, please reach out with any questions. As well, I want to thank you for taking the time to join us. Talk to you soon.